We've been asked to debate an issue which is a recurring theme, certainly for seekers of finance, for project sponsors and for asset managers. I'm going to move back slightly. About how do you actually access the money? How do you get to the pension funds and how do you get to the investors? And I thought to set the scene, I'd just say a couple of things about both of those components of this discussion, both the infrastructure space, the seekers of capital, and the pension funds and investors, the holders of capital. I think broadly speaking, over the last 5 years, a couple of things have happened. There's been enormous growth on the demand for infrastructure finance of a global nature, and with that has been a plethora of different structures which have been developed in the form of investment trusts, infrastructure funds and the likes, which have sought to facilitate the flow of capital from one side to the other. At the same time, investors have been exploring their investment horizons in pursuit of, in some instances, higher yield, in some instances, a more balanced portfolio, in some instances, just looking for a dividend which is not necessarily financial of nature. And within that pursuit of other investment classes, they've been looking at alternatives, or what's called other in many asset allocation boxes. And infrastructure sits somewhere in there. But the flow between these two components, infrastructure and investors, hasn't been as fluid as one would expect, and there are still many challenges which do exist that impede that flow. And this panel will hopefully discuss those, will give some insight as to what these challenges are and how they can be addressed, and give us some sense of the way forward. I'd like to try to dimension those comments just before we move on. With the decay of existing infrastructure on a global basis, as well as the demand for additional infrastructure to support and fuel tomorrow's growth, there is a continual need for infrastructure going forward. Current research puts that demand to be almost at 3.5% of global GDP. That's equivalent to $2 trillion per annum. So not a small sum. Not unsurprisingly, the bulk of that, $1.2 trillion per annum, is needed in developing countries. Collectively, that equates of the GDP of developing countries, roughly 6%. 6% of GDP of developing countries needs to be deployed into infrastructure. So it's a large number. And the way that that's been addressed by the private sector over the last 5 years has been the emergence of infrastructure funds. 5 years ago, there was roughly $100 to $150 billion in infrastructure funds on a global basis. 2007 was probably, for fund managers, regarded as the most successful fundraising year. In that year, $45 billion was raised into infrastructure funds on a global basis. And since that zenith, it has trended down. As the world has slowed down, that number has decreased. 34 was raised in 2008. 8 billion was raised in 2009. But the tide has turned. This year, commitments to funds globally are running at $24 billion. And impressively, half of that has been committed in the last quarter. So in terms of appetite into infrastructure space, liquidity and commitments to funds, the pendulum has swung, and it appears like we're back to business as usual to a large extent. If I add up those totals, I get to about $260 billion committed to infrastructure. Put that in perspective. The funds business globally is $25 trillion business. Of that, 16 trillion is in pension funds themselves. If one was to apply a 3% asset allocation to those funds, that would give you $500 billion allocation to equity. So notwithstanding the development of infrastructure funds and the emergence of infrastructure as a recognized asset class, it's still probably half, in terms of pension fund allocations, of what it could conceivably be, just to try to dimension where we currently are. So why is that? Well, it's probably issues like the peculiarity of infrastructure projects. It's the complexities that arise from infrastructure projects, like should funds be going to private or listed, the issues around SPVs and cash flow financing, Issues and concepts like gearing and leverage, the use of that in projects, the role of legislation and legal frameworks in these projects, all of which are new concepts and in some cases quite complex and challenging for an institutional investor merely looking for a alternative asset allocation. But having said all that, it's clear to me that we need to address this. We need to connect the dots between this pool of capital and what is becoming an absolutely apparent need on a global basis for the deployment of that capital, because the provision of infrastructure, as you no doubt heard, and you will hear over the next couple of days, is central to economic growth. In my view, the characteristics of the asset ideally suit the long-term exposure that pension funds and life funds are looking for. I think that the asset allocation, and certainly the current considerations around Reg 28 are not helpful, with only 2.5% of asset allocation going to this asset class. I don't think it's enough. And there's a story I just want to relate very quickly about what is enough and what we as practitioners, in my view, should be doing. And this I heard in the US recently. It's a quaint little story of a guy walking down a pitch dark road, and there's one single light burning on a lamppost down the end of the road. And as he gets closer, he finds a guy on his knees scrabbling in the grass below the light. And he says to the guy, "What are you looking for?" And he says, "I've lost my car keys." So he says, "Well, let me help you." So he gets on his hands and knees and he scrabbles around for 15 minutes and he says, "I can't find it. You sure you dropped it here?" The guy said, "No, I dropped it over there." So he says, "Well, why are you looking here?" He says, "Because this is where the light is." And my fear is that from an investment, the investment universe, the light is shining on where the other 95% of the asset allocation is. And what we should be doing is we should be putting up more lights in this alternative asset space. We should be putting up more lights in the infrastructure space so that more people are looking at it. And we should be extrapolating, putting up more lights around the continent so people are seeing Africa akin to, instead of scrabbling around in India and China, they should be scrabbling around in Africa because there are more lights. The DFIs do sort of measure their progress, I guess, on four major themes. It's the environmental, it's the social, it's the governance, and it's the financial. Certainly at a transaction phase, one does get the sense that it's the latter, which does get the bulk of the focus, but I think that's probably in the heat of trying to do a deal, they go, "Well, this is just commercial or too commercial." Having said that, I'm of the view that they do actually do a very good job on the first three things, on the environmental, the social, and the governance. There is a question of whether they're playing on the same field as their eastern counterparts, and whether the eastern counterparts have four dynamics over which they actually measure their traction. But I also think that the work that they've been doing across the continent for the last half a decade in terms of project preparation, policy reforms, and enabling host governments to capacitate themselves to implement and to host projects has been quite significant.
Doing business in Africa. You can't afford to be without Africa Investor.